Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. We've got PayPal earnings on tap. Just listen to the call. Stock is basically flat pre-market after the earnings call and release. The earnings call actually sent the stock up a little bit. It was down before the call itself, so I think some of the fears were assuaged a little bit after the earnings call itself. This is a stock that's down about 25% year to date. A lot of worries about the consumer, and PayPal is very much dependent on a strong consumer. The stock is still basically flat in the past year, ran up from about 58 bucks to 90 bucks before falling again into that 50 to $60 range. I've always been a buyer of the stock in that high 50s, low 60s, and I recently started a position in my stock buyback portfolio, so I do own these shares, and I do want to take a close look at these earnings to see how things are looking. So earnings themselves, a revenue up 1%, 2% currency neutral basis, total payment volume up about 3%, 4% on a currency neutral basis. So these are numbers that aren't amazing, but kind of what I expected as an investor. They guided towards shrinking revenue, shrinking TPV on the Q4 earnings call. Talked about how there's going to be 3 to 4 to 500 basis points of pressure from some new negotiations on the Braintree product with some of their bigger customers. They're really willing to walk away from revenue at this point from total payment volume because it'll help them get a higher margin percentage, a higher transaction margin dollar number, and that's really showing up in their earnings. Revenue growth, kind of mediocre. Transaction margin dollar growth, pretty decent at 7%. Non-GAAP EPS up about 23%, which is better than market expected. So revenue a bit lower than the market expected, despite the warning they gave in Q4. EPS a bit higher than the market expected. Active users still growing, which is nice to see. Active accounts up about 2%. Monthly active accounts up about 2%. A bit worrying that you're seeing a 7% decline in payment transactions, but I think that's part of their strategy to sort of move away from the high volume but low margin business of Braintree, and you're seeing that here, 7% reduction in payment transactions, but a lot of that reduction is coming from the Braintree stuff. Number of payment transactions, excluding payment processing, about 6%. That's, white label payment processing, about 6%. So that's pretty decent, pretty expected. Total payment volume mix across their platforms. Really, the focus here is always going to be branded checkout, Venmo, peer-to-peer, all of that stuff. And you're seeing shrinkage in payment service provider, their PSP, their white label stuff. If they're doing behind the scenes processing for Uber, for Airbnb, for these larger companies, the margins there are low, but the volume is high. So they're really growing that under the old leadership regime. See 24% growth in Q1 24, down to 2% growth in Q2 25. But that's very much the strategy, is their price to value strategy. They're deaccelerating growth, making that a smaller part of their overall business, and trying to make up that with accelerated growth in branded checkout, in peer-to-peer and other consumer and added value services and all of that stuff. And their idea is that, yes, this is going to mean a hit to total payment volume, a hit to total revenue, a hit to total transactions, but it's going to lead to better margins on the bottom line. So top line growth is going to slow, bottom line growth should get better. So they're clearly highlighting something here. It's branded experiences. It's Venmo. It's the PayPal branded stuff, whether it's online or offline via debit. It's Venmo, peer-to-peer, Venmo debit, all of that stuff. Other services are going to be key for them here. They talked about agentic shopping experiences, which is, their AI stuff. They talked about their new checkout, that it's going to lead to better branded experiences out there. They talked about the debit card a lot. They talk about buy now, pay later, other additive services that are going to be margin accretive, because they know that they're giving up total payment volume via their Braintree negotiations, their price to value strategy. It remains to be seen whether that plays out well in the long term, because obviously they're going to lose total payment volume, as they're showing here on the Braintree side. They have to make that up somewhere. So even if growth there is slow, it still has to be more than zero in order for this business to thrive in the long run. And that means that they need to get that growth from branded, from Venmo, from some of these other additive services, because it doesn't seem like it's going to come from Braintree in the future. And that may be a good thing from a bottom line perspective, but probably means that there's going to be some pain in the short term from a top line perspective. So you look at these Q1 results again, revenue mediocre, but it's a transaction margin dollars that are focused here, up 7%, really growing again for the first time in quite some time in the last year. And that's really why this has become an interesting investment again in my mind. And now that it's down into the 50s, the low 60s again, it's getting interesting as well. So looking at the guidance, you're looking at 4 to 5% growth on the transaction margin dollar side, 6 to 7% growth excluding interest. EPS growth on a non-GAAP basis, 8 to 10% growth, so a bit slower than Q1 2025. But in general, they talked about how they're being relatively conservative about the guidance they're giving, not only for Q2 2025, but also for the full year 2025. They're not making any changes to the guidance they gave in Q4 2020 for 2025, and that's because while they're happy around Q1 2025 results and the early part of Q2, they know that there's some macro concerns around tariffs, around the economy for the latter part of the year, so they don't want to overclub. They're keeping things as they are right now. However, if the economy stays steady, if the results they're seeing in Q1 and Q2 continues, they're probably going to beat on full year 2025 on an EPS basis, on a revenue basis, on a transaction margin dollar basis. And that's a pretty good sign for investors. However, you can't discount the fact that, hey, the economy might do poorly once these tariffs actually start impacting it in a big way. The nice thing they said is that, hey, the de minimis exemption might end pretty soon, so tariffs are going to be more impactful on lower revenue items, but only about 2% or less of their total payment volume is from Chinese businesses based in America or from China that are shipping from China to the United States. So that's a relatively small impact to their overall revenue. However, 2% is still a decent amount. And if the economy does tank, like I said before, this is very much a consumer driven business. So if the consumer is weak, PayPal is going to be weak. So I'm not really, taking too much into this, 6 to 10% growth being under club, because I know what could happen once these tariffs are into play. Once, if a recession were to happen, this is certainly going to be optimistic if that's the case. However, if the economy keeps chugging along as it has, then 6 to 10% growth might be a bit lower than you would expect based on what we're seeing in Q1 and Q2. And then remember, this is very much a share buyback story. They're generating 6 to 7 billion in free cash flow. They're buying back 6 billion shares. In the last 12 months, they've reduced their share count by about 7%. That's going to continue to be the case in the coming years. We'll talk about valuation in a second, but that's why I'm buying the stock. Even if their top line isn't growing a lot, they're going to be able to generate earnings per share growth, free cash flow per share growth, just by buying back 7 to 10% of their company every single year. One thing to note, $6 billion in share repurchases. They do also have about $1.5 billion in stock-based compensation, so that's a bit of an offset. And another thing to note on the negative side, yes, they're projecting 6 to 10% growth, but they have reduced their share count by about 7% in the last 12 months. So a lot of that growth is coming off the back of that share count reduction. Their bottom line isn't actually changing that much. It's just that on an EPS basis, they're getting 6 to 10% growth because their share count is down by about 7%. So that's another thing to keep in mind as well. As we look into some of this other stuff, again, total payment volume shrinking, moving in the wrong direction. We talked about why, but it's really the other concerning thing is that transaction rate, total take rate, those keep dropping as well. I will want to see that to start rising again before I really get excited about this stock. Right now, this number is still negative versus what it was in Q1 24. The transaction take rate is negative versus what it was in Q1 24. So it's still moving in the wrong direction. That leads to that low revenue growth. And you might ask, well, if transaction take rate, if total take rate are getting lower, how are transaction margin dollars growing? Well, they're growing because they've done a good job of reducing transaction expenses. So yes, take rate is down by 60 basis points, but transaction expenses are 6 basis points. Sorry, transaction expenses are down by 8 basis points. That leads to better transaction margin dollars. That's really the thing they're trying to deal with. Yes, transaction margin dollars are better, but it's mainly driven by the fact that they're reducing transaction expenses at a rate that's higher than they're reducing their total take rate and their transaction take rate. What's going to be exciting about this stock is when total take rate starts to be static or growing, when transaction take rate starts to be static or growing, and at the same time, transaction expenses start shrinking even more. That's when the stock is going to get exciting. Until then, it's kind of just okay, and it's very much hey, we're buying back a bunch of shares, we're valued fairly to undervalued, and when we get back to growth, this could be an explosive return when that happens. So let's take a look at the valuation here. What do I think this is valued at? And disclaimer, this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Do note that the stock market has opened. It's trading at 66 bucks right now. So you're looking at a 64 billion market cap, 65 billion enterprise value of about 66 billion. The balance sheet is pretty solid. They have about 15 billion in cash, maybe about 12, 13 billion in debt, some capital leases as well that are leading to this net negative debt. But overall, they have plenty of money to weather any economic storm that may be there. I'm not worried about this company going bankrupt anytime soon. They've been buying back stock in heaps in the last couple of years, 4 to 6 billion in the last 4 years per year. Do note that there's some stock-based compensation, 1 to 1.5 billion in the last couple of years per year. You get a free cash flow yield of about 10.4% based on 2024 actuals, closer to 8.5% after you account for stock-based compensation. What kind of growth can you expect here? And you can play around with the spreadsheet, hit file and make a copy. There will be a link in the description down below. So I have 1% growth for 25, 1% growth for 26, 3% growth for the next 2 years, and then 2% growth after that. I have margins staying where they are, so no margin improvement. I think that's relatively conservative, but again, if an economy crash were to happen, if a recession were to happen, I mean, this thing will see a dip in revenue like you wouldn't believe, down 20% without a problem, because this is so consumer centric. What are they doing with their money? Well, the majority of it going towards buybacks, 90% of the cash going towards buybacks, offset by stock-based compensation. You're looking at $24 billion in stocks being bought back against a $64 billion market cap. So you're reducing the share count substantially on an EPS basis, on a free cash flow per share basis. That's going to be a lot of growth, even if this bottom line doesn't move that much. Even if you see 0% growth, you're getting a significant buyback yield. What's the right valuation? Is it 10.5%? I think if the business can prove that, hey, we're offsetting the reduction in growth from Braintree with some of this branded stuff with Venmo, something in the 8.5% range seems relatively reasonable. So some re-rating to a richer multiple, you get that plus the buyback yield gets you to an expected return of about 13.3% at today's price. Let me fix that so it doesn't change too much with the market updates. Still, if I'm targeting a return of about 15%, I get a fair value of about 61 bucks. So slightly below where it is today. That's where I've been a buyer. High 50s, low 60s. Really interested in that stock. And the reason I like this stock is it's a relatively solid business, a good brand. I don't think it's going anytime soon. I think there's certainly some pressure on the take rates, on the transaction take rates. Now they're doing a good job offsetting that with total transaction expense reductions. But what happens if take rates keep dropping and those reductions can't happen anymore because they're as low as they're going to go? Is there going to be pressure on margin? Is there going to be pressure on revenue? There's still, some things they have to get right. They have to make sure that branded offsets the losses in total payment volume and revenue from unbranded, from Braintree. Can they do that? Can they do a good job growing some of these side businesses? If so, there's plenty of upside from this spot, because I am assuming relatively low growth, but I'm still assuming some growth. I'm still assuming margins staying where they are. If revenue starts to shrink, if margins shrink, then this won't be as rosy as I painted here, but this is a relatively reasonable assumption in my mind. And from here, there's plenty of upside. If they grow, if they expand margin, you're talking about returns anywhere from 10 to 15% based on relatively reasonable valuations. If the valuations start to expand because it's growing, even as a starting point, you're talking about 16 to 25% growth plus any growth you're going to get beyond what you're seeing here. So that's kind of where I'm positioning this stock. It's like, hey, I'm going to get a buyback and I'm going to wait for this business to do something. And the downside seems more limited than the downside of some of these other stocks that are priced at, 2 to 3% yields in this economy. Now, if a recession happens, is PayPal going to drop 50% from today's prices? Totally. But I'm completely okay with that because I think PayPal is a business that's got a pretty good balance sheet. They can keep buying back shares even while their business struggles a little bit and then recover once the economy picks up again. A couple of things to keep in mind. This is not recession proof by any means. It's very consumer heavy. Two, a lot of their revenue comes from international markets. If there is some reality to other countries not liking us, other countries not liking American businesses, will there be any boycotts of a company like PayPal? I'm not seeing any of that in the numbers yet, but certainly a potential risk out there. And obviously, there's a potential risk from tariffs impacting the overall spend of people, because this is a business that depends on taking, a dollar 50 from every dollar that goes through their platform. If the platform dollars suddenly drop by 20% because people are spending less, PayPal is going to see their revenue reduced by 20% pretty quickly. So that's something to keep in mind. However, with all that in mind, based on the latest earnings, based on these, I think, relatively conservative assumptions, I kind of like this stock. I'm going to continue buying a relatively small position. This makes up like 9 to 10% of my stock buyback portfolio that I've shared in the past. And it'll continue to be bought back. And if the stock tanks a bit more, I'll buy back a bit. I'll buy a bit more, because in the 50s and the 60s, I really like this stock. If you look at the fair value in this, no upside range where there's no re-rate, you're talking about a $54 fair value. And this all assumes a 15% target revenue. If you hit a 10% target return, you get a fair value of about $76. At a 15%, you get a fair value of about $61. So play around with this spreadsheet. Let me know what you think down below. Leave a comment, like, all of that good stuff. What do you think about these earnings? What do you think about PayPal? And if you want me to review any other stocks or any upcoming earnings, let me know down below. But otherwise, thanks for watching. Have a good day. Bye. I lied. One thing I forgot to mention, this is a stock that I think is going to take a while for this thesis to play out. I don't think this is a stock that's going to move from 60 to 100 in a matter of weeks. It might be years for this to happen, and I'm perfectly comfortable just buying at these low prices for a while I wait for this thesis to play out and then see what happens, because I think this is going to be a thing that takes a while to play out, this transition from a company focused on revenue growth to a company more focused on margin and growing their branded experience versus total payment volume and revenue.